Okay, it says live on the top left corner, so I guess it is live. All right, so this is I believe, the second stream for Lombard in this format. First time for me moderating this. Jacob will help whenever needed, but yeah. So this stream is dedicated to our launch of a new product, Sentora DeFi Vault, where Lombard acts as a distributor for the strategy. Concrete acts as a infrastructure operator, and Sentora joins us as a manager and risk curator for the vault. So I would love to welcome Vincent, Lucas, and Jacob here on the stage. And yeah, please guys introduce yourself.
Yeah, thanks a
Jacob?
lot. So I'm Vincent. I am the marketing director at Sentora. Until recently into the blog, and thanks for having us here today.
From my side, I'm Lucas, VP of Institutional DeFi at Sentora. Basically, we lead institutional DeFi strategies with risk management enabled on an automated basis. Then we do risk management as well with our Risk Radar product that provides economic transparency into economic risks. And finally, we have an analytics product as well. That's it.
Awesome. And hey guys, Jacob Phillips, one of the co-founders of Lombard. Super excited to be working with the Sentora folks on this. I think this levels up Lombard Vault infrastructure quite significantly, which I'm sure we'll get into. So yeah, Maxim, you maybe want to do a quick intro as well?
Yeah. Well, my name is Maxim, I lead DeFi at Lombard, and yeah, happy to discuss this topic. It's been Wallsby has been a big part of Lombard's strategy, and we can cover this later in this discussion. I would love to kickstart this conversation with the very recent merger of Trident and Into the Block. This new entity emerged, Sentora. Guys, I would love to learn more about the motivation for the merger, what two parties are bringing to the table. We always want to see many great synergies when companies enter into a merger. It doesn't happen often in our space for maybe multiple different reasons, but it's definitely exciting to see decent amount of mergers and different sorts of M&A activities recently, and this is probably one of the loudest so far. So yeah, please share a bit more details.
Yeah, Vincent, do you want to take this one?
Yeah, sure. Yeah, so Into the Block has historically been best known for analytics product, but after DeFi summer in 2019, we noticed there was a big opportunity there. So a lot of our product development shifted in towards that area. That has gone very well for us. Worked with many partners in the industry, and one of these partners, Trident Digital, they complemented us in a lot of projects. So where our background is more on the technological side, their background is more in structured financial products, lending solutions, things like that. And as our business unit of DeFi solutions grew, this was like the next logical step for both the companies. And so with the launch of Sentora, it's really exciting for us because we can offer a much broader set of solutions to our customers. We work with many big DeFi protocols in the space, and our goal is to help them grow and get institutions into DeFi and help DeFi grow as well.
Great. Would you please uncover a little bit further on what's the main offering, core offering of Sentora today? I think Into the Blocks was always a little bit unclear for the broader crowd. People know it's an important name, and you guys are capable to drive a ton of flow. But Yeah, maybe there is at least a small gap in the general broader understanding of what is the main core product that you guys offer.
Yeah, of course. So
And hey, Vincent, also, would you talk about like the types of people you're working with? I know that you guys work with some of the biggest players in all of crypto, especially at the institutional level. So it'd be interesting to dive into some of those folks.
yeah, exactly. So this question is a little bit connected, right? So our background, like I said, is in analytics. A lot of retail users use the Into the Block analytics platform, and that's why, like, a big part of our brand awareness was around this kind of niche, right? But the majority of our activities are actually around providing risk management solutions, DeFi strategies, and things more in that direction. So the clients that we work with are actually on two sides. On one side, we work with many of the leading DeFi protocols in crypto, like Lombard with Aave and etc. And then on the other side, we work with big capital allocators, institutional investors that are looking to earn yield on their assets.
So you can think of some of the largest centralized exchanges, their earn programs, lenders, funds that want market neutral strategies. The core offering has evolved into, what's the best way to get market neutral yield on your assets, such that the risk management is fully automated. So, for example, against BTC, right now you can get points with Lombard and Babylon, and soon you'll have AVS yield. But the reality is there's no established yield thus far. So we can get yield on top of those points through like lending against it and deploying in capital strategies elsewhere, while automatically managing the liquidation risk. DeFi can be quite unforgiving with liquidations, so it's not apt for manual rebalancing, which is why we focused on just automating all of the risk management, and that has proven to be the best approach for institutional DeFi, for institutional capital to get comfortable with DeFi.
Yeah, I think one of the things that has surprised me a bit about how I almost feel like DeFi has evolved a little bit slow with regard to automated risk management. It seems so obvious that because markets move quickly, funds would need to move around, liquidations need to be managed quickly, but yet it seems that more often than not, even with Lombard's previous attempts at DeFi's previous attempts at DeFi vaults, and then even with Lombard's, we find that a lot of infrastructure that I would assume would be relatively automated is actually behind the scenes just someone with some off-chain alerts, like clicking buttons on their end. But you guys seem to be doing this much differently. So would you maybe dive into some of that? Like, what does it mean to like automate all of this risk management infra, and how is this step function increase from what others are doing? And I mean, I'm curious if you sort of agree with the sentiment I shared about how like stuff should be automated, but really it's just manual.
No, it should definitely be automated in a world that is 24/7, like crypto is. And basically, we started with the automation on a position level. So we were initially, doing like farming compound back in, late DeFi summer when that was still going on. And we realized, if you automate it with flash loans, you can do it a lot more efficient than if you're just clicking the screen back and forth. And then as we started doing more complex strategies, it became clear that the automation was even more important. So we started by, mastering at a position level, how do we mitigate depegging risk, liquidation risk, impermanent loss, etc. All of the like core blue chip risk factors. And then at a vault level, we're heading to this like portfolio approach where we need to set triggers on, okay, max you can do is 10% on these types of strategies, 20% here. We only need this allocation to this blockchain, X and Y to the other. So right now it has been fairly discretionary and disorganized, but we're in the process of also extending the capabilities of the risk management that we had done at the position level, such that at the vault level you can have the optimal portfolio, and makes it more transparent and better risk managed product than just like a random guy pulling their transactions.
So does it look like on the management side, right? Do you guys? Well, we sort of know the answer, but I would love you to talk a little bit more about this. So you never actually assume custody of the assets, right? The entire system is operated by smart contracts. Can you explain why that is the case? Why you decided to go this route? It's probably more difficult to automate, probably a little bit less flexible, could be way more expensive on the monitoring and on all this stuff. What makes you pick this route, and does it provide you any edge when you pitch this product to institutional clients? Do they find this particularly interesting?
Yeah, that's a great question, and it's a trade-off we explored early on. And it was pretty clear to us that if we wanted to reach large scale, we wanted to err on the side of security. And it's much more secure to be non-custodial and have each client be able to access their funds. So that's how we've been able to work with some of the largest treasuries and exchanges, where we are essentially a technology platform. If we had custody, we would also legally be more of a financial advisor. So it was better for us to scale to be a technology provider. So what we do is we provide a set of smart contracts. Oftentimes our institutions will review the contracts and make sure everything's in place. And those are basically a pass-through into the protocol, but they connect to our off-chain simulation models, where we have all the risk management. We don't do it on chain itself because it would be too costly to run these simulations. And if our simulations flag, a risk parameter, they can automatically rebalance or even exit the protocols if there's a large risk at hand. And so we added more and more risk triggers and factors that we model over time, of course, as these get stronger and more battle tested. And ultimately, it seems to have been the correct decision to go on that path of making it non-custodial versus just being a financial advisor of sorts.
Interesting. And from the standpoint of risk management, I'm really curious. Yeah, if you could share more, because there are multiple third parties, like Hexagates of the world, where there are systems of different alerts and signals reporting on different variables fluctuating at certain moments in time. What are the risk parameters that you're particularly following very closely, and how does the automation work? Is this like semi-automation where you would still need someone to make a call manually to rebalance at important moment in time, high volatility moments in time, or is it actually entirely automated? Do you strive to have it entirely automated, or maybe there is still some degree of manual oversight that is very important because maybe automation is not capable to account for all the corner cases?
Yeah, so we do both monitoring based on constraints or parameters that flag, and full triggers that execute. We have opted to be increasingly automated over time, to be able to rebalance at times where we're literally asleep, for example. But a good example why you don't want to have everything automated is a lot of these factors are self-correcting. So for example, we do a lot of strategies where we borrow ETH or stable coins, and as you guys probably know, there's a kink, like a point of inflection in the borrow curves, where if there's too much borrow, the borrow costs go up very quickly. That's usually self-correcting. So what we do is we get a notification, like an alert, sent to our internal monitors that borrow costs have spiked and maybe this strategy is less profitable now. But we take some time to evaluate it. It's still a bit more discretionary there. to see if it's worth like repaying some debt when that happens. Because the reality is a lot of people are in that circumstance, and there's incentives to repay debt at that point. And usually the best is just to like do nothing. So we have the ability to fully automate it and exit if our borrow costs spike. But the reality is, since it's a more of a short-term phenomenon, it doesn't make sense to fully automate that as an exit trigger. On the other hand, one thing that does make sense to fully automate is if we're taking a loan and our health factor drops to a given level. So if we're close to liquidation, we do want to automatically, without looking at anything else, just repay that immediately, because we don't want to get liquidated at all costs. And historically, we've never have. So that's one thing that we need to be able to do automatically, and that I wouldn't be just monitoring. So we need to explore those types of risks. And I guess the ones that are more urgent, of course, are best suited for full automation, versus the ones that are like more soft risks are fine to just monitor.
Understood. Yeah. Do you want to name maybe 2 or 3 core parameters that are like particularly important? So I understand, yes, you already mentioned LTV, and getting close to the liquidation threshold is not convenient. We need to automate that to repay the loan or to add additional margin to improve the LTV. Is there anything else that is also like this level of critical?
Mm-hmm. I guess on the lending side, we also care about the available liquidity. So that's tied to the utilization ratio. Basically, if there's too little available liquidity, it's possible that we won't be able to exit if we're lending, or if we're borrowing, it's possible that our borrow costs will spike if someone withdraws their supply. And then that's on the lending side. So these are like two-legged strategies. And then we care about risk on the second leg, of course. So if we borrow capital, like say USDC, and deposit it on a DEX, we then look at our concentration of that pool. In a protocol like Curve or like other stable swap invariant AMMs, there is this thing where if you exit with a large portion of the pool, you sort of imbalance the pool and you're penalized. So there's this sort of exit fee that we've gotten very confident. Very confident is not the word. Very proficient at modeling. It's actually like freely available in our risk radar tool. So we track relative to our concentration in a position what would be the exit fee we expect, and that essentially leads us to determine what's the optimal concentration we should have in a pool. If that concentration increases, we can automatically exit. I can tell you in the 2022 bear market, that saved us from a lot of depegging events with staked ETH and other assets. And then, of course, the prices of these assets as well. So if you're holding a newer stablecoin, you might, not be fully comfortable holding it if it depegs. So we have these sorts of stop loss mechanisms where, if it drops to 98 cents or whichever factor we determine to be optimal, we can automatically exit. And, that has also saved us from other stablecoins collapsing. So that gives you an idea. All of these factors, we've gotten years of clients and protocols ask us about what we do, which is why it led us to this like risk radar platform where we do a lot more transparency on these factors. And ultimately, that's free to access for everyone. And what Sentora does is the automation on top.
Great. Okay. So how about we dive a little bit deeper into what we are actually launching here together, and talk more about the DeFi strategies around the our joint product. So what do you think would be the major source of yield for Bitcoin for the vault? So obviously it's been really tough to source yield within DeFi for Bitcoin for many reasons, and I guess primarily the core one is that there is not really a lot of sustainable high borrowing demand for Bitcoin, as it happens to many other assets, which normally becomes a huge source of yield for those assets. And in case of Bitcoin, you can't really lend it out and make a big chunk of money from it. So you got to get creative, and you got to most likely collateralize your Bitcoin and figure out some other sources of yield, which are not necessarily Bitcoin denominated. So very curious, what did you guys come up with, and how are we going, how are we going to beat the market and perform well?
Yeah, in reality, it's a hard problem. It's not easy to get yields on Bitcoin, and you're prone to liquidation if you're borrowing against it, which is why we've been expanding our product suite over the past 3 years to be able to do more and more on Bitcoin yields, which is often a pain point for most capital allocators. And I think for the Lombard Vault specifically, it's a combination of borrowing against it and deploying in other strategies, but also deploying the LBTC and RapidTC that the VR chain vault holds into ecosystems that need them for growth. Let me elaborate on that point. So we're in an industry that is probably overinvested in infrastructure, and that's a result of the big infrastructure premium that L1s and L2s have. And as much as these projects get funded, basically they all need to compete for liquidity, which gives some leverage for the top applications like Lombard to be able to grow along with these ecosystems. So we're working with this vault with some of the top Bitcoin L2s, for example, helping them grow, bootstrap their networks early on in a way that it's in protocols that are battle tested and doesn't add too much risk for the Lombard holders, but it's still very attractive for these L1s and L2s to incentivize. So a lot of the yield will come from those incentives that get ultimately passed on for the end user. That's like one bucket. And then the second bucket is, just borrowing against the Bitcoin, managing the liquidation risk, and deploying that usually stable coins or ETH in strategies where the cost of borrowing is much smaller than the value you can gain from deploying it. And that's, typically can be achieved in a market like this where borrow costs are relatively low, but there are still some good opportunities if you look hard enough.
And is there any? Do you observe any kind of reflexivity in terms of how the underlying strategies that you described perform? Does it perform differently in different stages of the cycle? Obviously, right now the borrowing costs are definitely compressed on average because there is less excitement and hot opportunities popping up. But how does it change within the bull market? Because intuitively, it sounds like there should be more stuff to do, but then the borrowing cost also goes up. So is it actually much easier in the bull market, or is it a whole different challenge?
Yeah, no, you're completely correct on that point. What we've seen so far, and this is probably our second bull market, if you can call it that now. But what we've seen is the bespoke programs for like L1s and L2s and even applications are typically more common during the bull market, and borrowing costs, as you do mention, increase during the bull market because a lot of people are getting leverage. So it's perhaps less interesting to do what we call supervised loans, borrowing against your Bitcoin when the market is pumping, especially if the borrow rates are like above utilization levels. It doesn't make sense to borrow above the kink. And we opt more for like direct strategies, helping bootstrap new ecosystems. And then when the inverse happens, when it's more of a bearish or quiet period, it's usually better to borrow against your Bitcoin or other non-yield generating assets, and then just deploy the capital that you borrow in a strategy that earns more.
Understand. And for the notion of borrowing and reutilizing non-Bitcoin assets down the line while collateralizing Bitcoin, do stablecoins stand out as the primary source of yield, or is there anything else that is capable to to generate some positive spread between the borrowing cost and the potential opportunity?
Yeah, it depends. Right now, stablecoins have been great because stablecoins are very essential for a lot of ecosystems and applications, and so therefore there's a lot of good opportunities where you can deploy stablecoins still at like 10% plus. And we've gotten to the point where protocols like Aave have gotten so battle tested that people are comfortable leaving it there, even when stablecoin rates are like treasuries, basically. You can argue if that makes sense or not, but ultimately for the borrower, it's great to borrow at basically treasuries plus 1% or so, and then be able to allocate into other strategies. That being said, I would say it's been more consistent strategy to actually borrow ETH instead of stablecoins, because ETH is also a very common asset that people like to look at leveraged on, which makes the borrow cost for ETH very low. It's the number one asset deployed on Aave, I think over 4 billion or near that level, supplied on mainnet. So there's a lot of ETH that you can borrow, and you can get yield on like leverage restaking strategies, for example, is one that we typically do, or on supplying to a DEX pool even can get a lot of fees because ETH is ultimately one of the most traded, if not the most traded asset on Ethereum mainnet. So you can get a lot of fees, like more organic yield, quote unquote, while still getting a good amount of incentives on ETH. What you do need to make sure is if there's a reversion of the trend where ETH suddenly pumps against BTC. Hasn't happened in like a year, but you need to be prepared in case ETH BTC reverses to repay your ETH debt, which is why ultimately we do automate it. Both on if we're borrowing ETH or stablecoins, we automate our health factor rebalances.
Okay, yeah. Well, I have my own ideas about borrowing ETH for Bitcoin, with the purpose of shorting it, but that's a whole different purpose.
Mhm.
We do want to stay market neutral. Our only bias is Bitcoin in this case, and yeah, definitely not making directional bets with the vault. But who knows? Maybe one day this could be a whole separate product.
I mean,
Yeah.
it would have done great the last year, but I'm not saying we should do it.
Well, I mean, if it's a very specific one, and all the disclosures are made very transparent, people can make their choice.
Maybe another day, another
Yeah,
vault.
for sure. Okay, so I understand ecosystems incentives is probably one of the core sources of yield still today. So would you agree with that, or do you think it's probably 50-50 between the real organic DeFi generated yield coming from fees versus incentives that are earned while being deployed into the strategy?
Yeah, it is. The split changes. Again, in bull markets, we do see more projects incentivizing because they can get growth and their tokens are getting more of a floor. When the market comes down, like now, we see incentives be a smaller portion of it, and organic yields take a larger portion of the yield production. So we rely more on like staking yields and leveraging those staking yields when the market's correct, while still having, we're in the privileged position where we have a lot of deal flow and connections with the main L1s, L2s applications. So if they need to bootstrap a product and it's good on a risk perspective, we also evaluate a lot of those deals, and there's still a good amount of them around. I don't think we're like in a deep bear market, but in 2022, especially, and even 2023, first couple of quarters, it was very hard to get those like incentive-driven approaches, especially at scale. Maybe you can get like 5 to 10 million, but definitely not at 100 million plus, like we did, in late 24.
How far do you think we can scale at this point within the current market conditions with the target rates of 6%, 5-6% annualized? How big do you think this product can be to sustain those levels?
Yeah, this can be a couple 100 million into this vault at 5 to 6% rate. I think it's attractive both for depositors and also like for projects that we collaborate with for this. But it ultimately depends on market conditions. If Bitcoin skyrockets to 120,000, if we get like the government to actually buy Bitcoin and not just hold the strategic reserve, I do envision that a lot of the premiums for these, especially the Bitcoin L2s, will increase, and therefore we'll see like higher yields as a result. So ultimately, it would be great if we can do it at high single digits. Right now, it's not the best market environment for that, but it's possible. And it's also, we can also not guarantee that the market will completely collapse and then yields drop a bit more. I think we're in a good position that's balanced and not taking risks that are too aggressive right now. So yeah, currently a couple 100 million at 5-6% is feasible, and we just periodically reevaluate and have our parameters on what's the max we can expose to new ecosystems and things like that are a bit higher risk for the depositors.
Great. Okay. Well, on the, it seems like we went pretty deep into the vault construction, the strategies, and the risk procedure. Jacob, my question is to you. Next question. What do you think? How do you think we should position this product? Who is the core audience? And yeah, what's the entire vaults thing for Lombard? What does it mean for us and in our roadmap?
I think the vaults layer for Lombard is representative of our fundamental view on how DeFi is evolving, in that users, particularly retail users, are very bad at deploying efficient liquidity, right? Like the number of market makers in the DeFi landscape are very few. Most users don't know how to manage a liquidation threshold or shouldn't be trusted to do so. The fact that we now have, as you guys described, technology to be able to build these sort of trust minimized vaults with different restrictions on what a technology provider like yourself can or cannot do, but still allow them to provide sophisticated management for assets within these protocols, means that users' liquidity can now be put to work at 4, 5, 10, 20x more capital efficient than what user would be able to do otherwise. I used to work at a derivatives protocol, and we had this problem where users could use as much leverage as they want. You could put down $1 of USDC, and you could make up to like $20 or $25 of liquidity from that, because it was all synthetic leverage, very, very similar to like using leverage as a perps trader. But users were coming into the protocol and they were doing like less than 1x leverage. And it was crazy. And then I had market makers who were doing 15 or 20x leverage. And so if I had found a way to reallocate that capital, if I had found a way for the market makers to be able to direct the capital of those retail liquidity providers, I could have 10 or 20x liquidity overnight. And this has sort of been the same strategy for Lombard. If we are going to enable Bitcoin capital markets to then become this foundation of liquidity that ultimately leads to a full-fledged Bitcoin DeFi ecosystem where people are building all these Bitcoin businesses, to solve that first piece of the problem, which is bootstrapping all of this liquidity, we need to do so in the most efficient way. So the fastest way to make this happen is to work with guys like the Sentora team to sort of be the backbone of the management of this strategy. So when we launched with the Lombard DeFi Vault, that we sort of through all of our effort into bootstrapping, this became the largest deployer of Bitcoin liquidity throughout the Lombard ecosystem. We then became like the second, I think the second largest WBTC pool, maybe the third, and the I think the again second or third largest CBBTC pool. So now we had a couple of the largest Bitcoin pools on ETH mainnet, and then ultimately I think the largest Bitcoin pools on Barachain. And I mean, there was like $200 million in that pool managed by one of our active vaults that I think was maybe the largest Bitcoin pool in all of DeFi. Again, all through these like distribution primitives that provide really efficient liquidity to the ecosystem. So I don't see us stopping this strategy anytime soon. And I really think that like, you know, working with Sentora team and other folks of similar nature is going to be the catalyst for speeding up the adoption of DeFi, you know, like 4 or 5x. Yeah, I mean, we're starting with some simple strategies, I think, like deploying liquidity into very well-known DeFi protocols, running very standard strategies. But I would only expect the sophistication of these vaults to grow significantly over time. So I think people have been talking about like, you know, like copy trading and all these different like markets for everything, sort of spin up your own vault or fund. This has been something people have been talking about for many, many years. And now we're like finally seeing it come to fruition in DeFi now that we have, you know, battle tested smart contracts to be able to house this sort of risk. But yeah. Max, you probably have thoughts on this as well.
Yeah, just, you know, I think distribution wise, it has been also an amazing tool for us to acquire entire new audiences. Oftentimes the new vaults are deployed specific for new ecosystems that are basically isolated to a certain ecosystem, and then we find ourselves attracting quite a good amount of users who are totally new to Lombard that are coming from those native ecosystems. Obviously, Barachain has been this crazy example, an absolute success in all the metrics possible. It's been a $350 million TVL product, but what was extremely important for us is the amount of users. We totaled 30,000 depositors, unique depositors into this thing over the course of a week of being open, right? So that's a tremendous distribution. We're getting the similar exposure to Sonic ecosystem, to Tag ecosystem, and many other that we are launching with today. Corn is running their own instance of the similar vault, where Lombard is the most active participant through our DeFi vault as well. So this is number one, and then so distribution it has helped a lot, and then number two, besides optimizing and delivering good amount of yield in a relatively conservative and secure way, what has been really helpful is exactly what Jacob described about the liquidity provisioning. Our DeFi vault, the very first instance of it, which we launched probably almost a year ago, has been consistently our biggest liquidity provider for LBTC across various ecosystems. Many different DEXs, different types of DEXs, concentrated liquidity, standard stable swaps from Curve, etc. This is the level of design that, like incentives design, that you cannot achieve without the structure. If we did not have a vault and we were just trying to tailor our point system to the point where incentives make the highest provide the highest output for the most demanded outcomes, like liquidity provisioning, the tightest ranges as possible, we would not be able to achieve the similar level of again, flexibility, control, and stability of the liquidity. And then we've been talking about this for a long time before, but it all boils down to the robustness of the asset. This is what lets us enter Aave as the only Bitcoin LST today. This is what lets us claim that we are the most peg-stable Bitcoin derivative, or one of the most stable peg-wise Bitcoin derivatives, because again, liquidity matters. People want to be confident they're able to liquidate their position, and that's the whole point of liquid staked asset. If you were not able to liquidate it without any significant slippage, there wouldn't be any purpose for it. So there is this really interesting balance between ecosystem, the ecosystem growth and general utility of LBTC, and then generating yield and generating distribution. So okay, on that note, Jacob, I'm curious how you feel about the vault in comparison to what is out there in the market. How do you see the edge? And yeah, obviously, yeah, Lucas, also feel free to jump in on this question. I'm very curious to let people know what do we see as our edge here.
Yeah, let me give a quick one, and then I'll pass it over to Lucas. I think, Maxim, you and I were both like crazy excited when we first started talking about this concept of building all of Lombard distribution upon these DeFi vaults, because we saw the power that could come from this, right? Like we were talking about like, oh, this starts with really efficient UniV3 liquidity provisioning, and then it becomes like, you know, running leverage strategies that no one else in the market can run. And then it becomes order book market making. And then it becomes, you know, leveraging centralized exchanges to run like perp strategies and all this stuff. And honestly, I think that we've both been a little bit disappointed with where we've gotten so far. The existing vaults in the market are just a lot simpler for reasons around risk management. I'm sure doing this stuff is a lot more complicated than it seems, but you know, we haven't been able to achieve everything that I think we hoped we would be able to with these vaults. Case in point, even the UniV3 liquidity provisioning that I think we see with a lot of vaults in the marketplace turns out to not quite be as active as we would have hoped. You know, the vision is like, oh, there's a market maker behind the scenes providing really active liquidity. And in reality, it's like, you know, week over week rebalancing or something like that. These vaults just aren't as quick in terms of feedback loops as we would have hoped. So the dream here, I think, is like a institutional professional strategist on the back end who treats this as if it was, you know, their own kind of client's capital effectively. And yeah, I mean, that's where I think Sentora comes in here quite beautifully. They're going to run strategies that, you know, no other vault in DeFi is going to be running. They will be able to provide capability, I think, down the lines that'll give us access to new sources of yield and platforms for enacting different, you know, trades or views on the market that no one else will be able to. Lucas, anything you'd agree with or disagree with there?
Yeah, no, I agree. And I think you guys have pushed the boundaries in terms of distribution, and, you know, you have clearly executed gratefully in that sense. And now it's a matter of optimizing what you do with that distribution. You're right that, you know, doing proper DEX liquidity is a great starting point, but there's a lot more that you can do. And that's why I think, you know, we always saw potential in this partnership with you guys, where we can combine our institutional grade risk management and also like broader reach of strategies with your distribution in a way that is, you know, more attractive for your users and for your protocol to grow. And I want to take it back to like why the vaults are important, is that I think this is like an opportunity to tie it back to crypto's ethos, in the sense that it democratizes structured products in a way. This is basically what this is. And historically that had been like, you know, only for elite like private banks that offer that to their clients. Nowadays with crypto, because it's all non-custodial, anyone in retail can access these types of structured products that before it was only for, you know, a handful of people to access. So we make it in a way that it's more attractive for the average user, and also for the protocol to grow. So, excited about this vault, and I think there's a lot of ways that we can continue improving over time.
That's a great point. Yeah, democratized professional institutional grade management. That's a great way to position this. And again, like from the standpoint of making it available for as broad audience as possible. Jacob, do you want to touch base real quick on our SDK solution and how we reach very significant partners, whoever you're willing to disclose here, and yeah, how is it helpful, and how does it impact the distribution?
Yeah, I think the SDK has been an awesome resource for us. The idea sort of being we want to bring Bitcoin distribution as close to the user as possible. And what this really means is integrating with the biggest centralized exchanges like Binance, Binance Wallet, and Bybit Earn, and also going directly to app developers to be able to serve this Bitcoin experience to them directly. Because one thing I think we've realized is that at the end of the day, there are like certain sources of distribution within DeFi, and I think we're only going to this is only going to sort of grow and compartmentalize more, where wallets, exchanges, user-facing fintech apps effectively will end up being a lot of the sort of source of distribution with DeFi. And what they need is just really easy tools to be able to interact with Bitcoin DeFi. No one really builds on Bitcoin DeFi because it's complex. There's a lot of nuance to building on Bitcoin. It's like what you really want is you want to be able to leverage all of the benefits of the infrastructure of like ETH mainnet and Solana without any of the complexity of like Bitcoin in the back end. So we kind of provide the bridge for this. So not only does Lombard provide the technical and security infrastructure in terms of a bridge, we also think of ourselves as like building the developer infrastructure that acts as the bridge to allow these people to integrate. So, I mean, some of the biggest ones have been working with centralized exchanges. These have been super successful integrations so far. And I think there's a lot more of this to go to. But again, we think of those sort of platforms as the entry point for Bitcoin into DeFi. And within that SDK, we prioritize the integration of Bitcoin directly into the vaults. So when users deposit BTC through the SDK through some platform and then mint it into onto Ethereum or Solana or wherever else, Parachain, you can actually you can mint and zap directly into the vault. So we call this our stake and bake feature. It's something we're pretty excited about. So that way you go directly from a Bitcoin deposit to a yield generating strategy without any sort of steps or extra clicks in between. One click Bitcoin yield generation is what we're sort of calling it.
Great. Well, we're a little bit over the initial planned 45-minute time. So to wrap it up, Vincent, Lucas, would you share what are the next steps for Sentora? Anything that makes you excited for the coming quarter or two that is in the roadmap? And then Jacob, I see there is a question apparently from the chat. I didn't know we have a chat, but whether Lombard plans to stake any other tokens, maybe staked XRP or something else.
Maybe I can take that one real quick. Possibly. There's nothing immediate on the roadmap. I think we're really focused on Bitcoin at the moment. This is kind of our core focus, but hey, we'll jam on it. Maybe we'll get back with an update there. But yeah, Lucas, Vincent, you guys want to take it away?
Go for it, Vincent.
Yeah, so of course, for the past year, we've seen a lot of institutional capital flow into crypto and very much into Bitcoin, of course. And with Sentora, we are going to be very well positioned to support these institutions to get into DeFi. Through our partners, and this is going to be the main focus. So we're building sort of the gap that's missing in crypto. A lot of the protocols that are currently in DeFi, they've been built for retail, and they're missing some things like risk management, like we've discussed today, or sophisticated strategies that are suitable for institutions. So that's going to be our core focus. and with the interest from institutions, I think that's gonna develop quite well.
Jacob, any closing thoughts?
I don't think so, other than just pumped to be working with you guys. I think the initial vault that we've stood up is just the start of the relationship between both of us. And I think this vault, already feels like a step function improvement upon DeFi vaults in the market, but it's only going to get better. So looking forward to much more to come.
Likewise. Yeah, excited to partner with you guys more closely. Yeah, I think that's it from our side. This has been
Perfect.
great.
Thank you for joining this this stream.
Yeah, thank you guys. We'll talk soon.
Thanks,
Bye.
everyone.
Bye.